Hey everyone, welcome back to Corporate Decoder. Today, DWS Global Small Cap Fund just filed its semi-annual shareholder report, and I am seeing some interesting trends in how they're managing your money. Quick note, this is not financial advice, just my take on public filings for educational purposes. This report gives us a really clear snapshot of where the fund is putting its money and how the costs stack up for investors. So, this is a look at the DWS Global Small Cap Fund. It is a fund that aims to invest in smaller companies around the world. The report covers the 6 months from the 1st of November 2025 to the 30th of April 2026. It breaks down how the fund is doing for its different share classes like Class A, Class RC, Class R6, and institutional class. Let's talk about the costs you pay as an investor. This is super important because even small differences in fees can add up to a lot over time. They show us this based on a hypothetical $10,000 investment. For Class A shares, the cost was $75 over those 6 months, which is 1.36%. For Class C shares, the cost was higher at $117 or 2.11%. Class R6 and institutional class had lower costs around $61 or 1.11%. The Class S shares were similar at $61 or 1.11%. Keep in mind these are the costs for just 6 months, and the prospectus mentions that without certain fee waivers, these costs would have been even higher. Now for some key numbers about the fund itself, as of the 30th of April 2026, the total net assets were around $200 million. That is the total value of all the money managed in the fund. They hold 168 different investments. The portfolio turnover rate, which tells us how often the fund buys and sells investments, was 26%. This means they changed about a quarter of their holdings in a year. And importantly, the total net advisory fees paid were over $713,000. That is the money paid to the managers for their expertise. Let's dive into where the fund's money is actually going. When we look at the types of assets, it is pretty clear where their focus is. About 97% of the fund's assets are in common stocks, meaning they are invested in shares of companies. Only 3% are in cash equivalents, which are safe, easily sold investments like money market funds. The rest is basically tied up in other assets and liabilities, which balances out to 0%. Digging deeper into the stocks, we see how they are spread across different industries. The biggest chunk, 18%, is in industrials. Information technology is next at 16%, followed by financials at 14%. Consumer discretionary makes up 10% and healthcare is at 9%. Materials, real estate, and energy each hold sizable portions of the fund, with utilities and communication services making up smaller parts. This shows a pretty diverse spread across the economy. Now let's look at where these companies are located. The United States is by far the largest part of the portfolio, making up 66% of the net assets. Japan and the United Kingdom each represent 6%. Switzerland and Korea are at 3% each, with Canada also at 3%. Germany and France are at 2% each. Italy and Puerto Rico are at 1% each. The remaining 6% is spread across other countries. This indicates a heavy reliance on the US market. It is always useful to see the top investments. The largest holding is Lumentum Holdings Inc., making up 2.8% of the fund's assets. Benchmark Electronics Inc. is next at 2.3%, followed by Casey's General Stores Inc. at 2.2%. TechnifMC plc is at 2.1%. And Madison Square Garden Sports Corp is at 1.8%. Then we have Affiliated Managers Group Inc. and Adea Inc., both at 1.7%. Bridge Biopharma Inc. is at 1.6%, and MaxLinear Inc. and Top Build Corp round out the top 10, both at 1.4%. It is important to note that holdings can change. Let's take a closer look at the actual investments named in the portfolio. This section provides a detailed breakdown of each holding, for instance. In Australia, they hold Dyno Nobel Limited and Aurora Limited in Canada. We see names like Aken Group Inc. and Finning International Inc. for Japan. There are companies like Alfresa Holdings Corp. and BML Inc. In the United States, which is the biggest part, we see holdings like ACM Research Inc., ADEA Inc., and Affiliated Managers Group Inc. This is where you can really see the specific companies the fund is betting on. This table shows the fund's financial position on the 30th of April 2026. Total assets were over $203 million. This includes the investments, cash, and other receivables. On the other side, liabilities were about $3.5 million, which includes things like accrued management fees and expenses. The net assets, which is what the fund is actually worth to its investors, were right around $200 million. This is the figure from which the share prices are calculated. This part details the fund's financial performance for the 6 months ending the 30th of April 2026. Total income from dividends and other investments was about $1.45 million. Expenses, including management fees, administration, and other costs, came to over $1 million. After expenses, the fund had a net investment income of around $411,000, but the real story here is in the gains. The fund saw a net realized gain of over $12 million and a significant increase in unrealized appreciation of over $25 million from investments. This brought the total net gain to a very strong $37.5 million, leading to a substantial increase in net assets. Let's look at the financial highlights per share for each class. For Class A, the net asset value at the end of the period was $34.23. The total return for the 6 months was a solid 23.16%, though this doesn't include sales charges. The expenses after reductions were 1.36% for Class C. The net asset value was $20.51, with a total return of 22.71% and expenses at 2.11%. The institutional class shares had a net asset value of $38.55 and a total return of 23.29% with expenses around 1.11%. These figures show how each share class performed and what it cost investors. The lower expense ratios for Class R6S and institutional classes are a key reason why they tend to deliver better net returns over the long run compared to Class A and C, assuming similar gross performance. These are the notes that explain all the accounting policies and details. For example, they explain how investments are valued. Securities are generally valued at market prices, but if those aren't available, they use other methods to figure out the fair value. They also talk about securities lending, where the fund lends out its stock to earn extra income. This is a common practice, and they explain how collateral is managed and the risks involved, like the chance of losing money if a borrower defaults. This is a really important section where the fund's board of directors discusses why they decided to keep the investment management agreement with DWS Investment Management Americas Inc., or DMA. They review performance fees and expenses. The board looked at comparison data and concluded that the management fees were reasonable given the services provided. They also reviewed the profitability for DMA and felt it was not unreasonable. They also considered economies of scale and other benefits DMA receives. The board also noted the fund's performance compared to benchmarks and a peer group, and they believe the fund's total net operating expenses remain competitive. Now, looking at the DWS Global Small Cap Funds report from April 2026, the fund is heavily invested in US small cap stocks, which can be very volatile but also offer high growth potential. The top holdings include well-known names in technology and industrials, but the overall portfolio is quite diversified across sectors and geographies. The fund's performance data shows a significant total return for the 6-month period, suggesting strong market performance or successful stock selection. However, the expense ratios, especially for Class C, are quite high, which could eat into investor returns over the long term. The board's review of the advisory agreement suggests they are comfortable with the current management fees and services. But it is always good for investors to do their own homework on costs versus performance. The key thing for investors to watch here will be the fund's ability to consistently outperform its benchmarks and peer groups, especially after accounting for those higher fees on certain share classes. The heavy weighting in US stocks also means performance will be closely tied to the US economy and market sentiment. That is my take. Stay decoded. If you found this breakdown useful, please give it a thumbs up and subscribe for more. All my research tools are linked in the description.